Introduction to gold versus bonds, gold and bonds. Two assets that investors have long considered safe havens during uncertain times. While they are often grouped together under this label, they actually behave very differently depending on economic conditions. Understanding how each reacts to inflation, interest rates, and broader market changes is essential. The comparison between gold and bonds truly begins after 1971. This moment marks a major turning point in financial history. Before that, gold was directly tied to the US dollar, limiting its price movement. After 1971, both gold and bonds began operating in a free market environment, allowing for a more realistic comparison. It is also important to recognize the fundamental difference between the two. Bonds are debt instruments that generate income through interest payments, while gold does not produce any income. Its value comes from scarcity, trust, and its role as a store of value. This distinction plays a key role in how each performs over time. Why 1971 matters. The year 1971 marks the end of the US dollar's convertibility into gold. This shift created a fiat currency system where money is no longer backed by a physical asset but instead by trust in the government. As a result, gold became freely traded and its price began to fluctuate based on market demand and supply. Similarly, bond markets became more dynamic, with interest rates reflecting real economic conditions. This transition allows us to analyze the true behavior of both assets. Without it, gold prices would have remained artificially controlled, making any comparison less meaningful. For investors, this period marks the beginning of exposure to modern financial forces such as inflation, central bank policies, and global economic events. Core idea of the article. The main idea of the article is to compare gold with 10-year government bonds. These bonds are widely used as a benchmark for long-term interest rates and provide valuable insight into market conditions. The analysis focuses on inflation and interest rates as these are the key drivers behind the performance of both assets. Rising inflation reduces purchasing power and can negatively impact bonds, while gold often acts as a hedge. Another goal is to understand how these insights can be applied to portfolio strategy. There is no single asset that always performs best. The key is recognizing the economic environment and adjusting accordingly. This presentation sets the foundation for understanding how gold and bonds behave across different time periods.